all here at the 2009 Canadian Business Leadership Forum, and I'm joined today by David Rosenberg, who is Chief Economist and Strategist with Gluskin Sheff Associates. He's also one of Canada's leading economists. Thank you very much for joining us.
Well, thanks for the
today.
invitation.
I should start by noting the date, that it's October 21st, given how the economy seems to change week by week. But right now, at least, the news seems to be relatively sort of positive. So how real is any sort of economic recovery right now?
Well, we seem to be in a recovery phase right now, but it's not really being fueled by the private sector. That's the issue I really have. It's being fueled by this unprecedented stimulus, especially in the U.S. And what we don't know, what we need to find out eventually is how does the U.S. economy look once the life support from this unprecedented government incursion into the capital markets and into the economy. When that starts to subside and we can see the private sector walk on its own two legs, I'll be a lot more convinced over this one particular word that's very important, which is sustainability. What is the sustainability of the recovery without the necessity to have as much government intervention as we have right now?
When do you expect that government stimulus to subside?
Well, it's difficult to say because if we suffer a relapse, there's going to be more fiscal stimulus. And let's use September as a barometer. Cash for clunkers ends, and what happens to auto sales? In the U.S., they go down to 9 million units at an annual rate, which was tied for the second worst month in the past 3 decades. So we had cash for clunkers. We get to 14 million units, have a pop, shows up in the retail sales, going to show up in the GDP numbers. Take away cash for clunkers, and we're down 30%. Right now, look at the housing market in the United States, which is trying to put together a very nascent recovery. And again, it's being fueled by what? Being fueled by housing tax credits to first-time buyers, being fueled by the fact that the FHA, which was established in the 1930s to help out low-income families, traditionally they had a sliver, like 1% of their mortgage market. Now they're financing 40% of the mortgage issuance in the United States with a 96.5% loan-to-value ratio. So, we have when do they take the stimulus away? It is the big question. For investors, I think the operative question is, what price earnings multiple do you put on the market? And when you consider that this is being driven right now by tremendous government stimulus as opposed to real, organic, private sector economic activity.
Well, and the markets have been rising a lot. I know that you're known as a big bear in terms of equity markets, especially the U.S. equity markets. Are there areas that you think are actually okay, or is it pretty much concern right across the board?
I'm more bearish on the U.S. equity market than I certainly am on the Canadian equity market. Although I don't know if we call the Canadian equity market a market. It's 50% resources, 35% financials, and it's really just a barbell between commodities and banks. Nothing wrong with the Canadian banks. I think they're in good shape. I am particularly bullish on commodities, and that's because I have this particular view on the secular dynamic growth potential in Asia, and they're the primary drivers of the commodity sector. One of the reasons why the Canadian dollar has done well, resources I think have secular properties that I'm actually optimistic on. Within the equity market itself, my focus is really on non-cyclical, large cap, more defensive than, say, cyclical. When I say cyclical, I mean prone to U.S. consumer spending, which I think is going to be a disappointment. And so I'm focused on, say, large cap companies, even in the States, large cap companies that can benefit from a weaker dollar. So we're talking about multinationals that have, say, footprints on the other side of the ocean. I'm talking more specifically about footprints in China and India, and a focus on income. So the corporate bond market actually has been a fabulous place to be, with better part of the capital structure that you line up in, and you get a very good yield in an overall deflationary environment. And I think there is this pervasive income theme. So income, not just from the government bonds, but from corporate bonds. And we deploy these strategies at Gluskin Sheff, and dividend growth, dividend yield in the equity market. So it's not as if I'm bearish on everything. I think there's fewer and fewer things that I can isolate that are actually cheap or inexpensive or have value. But there are areas, I think, that have long-term potential. I still think corporate bonds being one and commodities being the other.
Very interesting. Thank you very much for your time.
Thank you.